Hey everybody, welcome to Shine's Trading Room again. We have Jim Riggio here again, the options master, with us. I wanted to hop into a quick educational series and give you a couple bullet points in some of Jim's favorite strategies. And we're going to take a look at today, I believe we're going to be talking about selling puts, some of the advantages and disadvantages of selling puts. It is a strategy that I use very often, but I want to give it to you guys from Jim's standpoint. So I'm going to hop out of the picture. You guys enjoy the show.
Thank you very much. You know, one of the things that Shine asked me to end talking about is some strategies where you have edge. A lot of people end up thinking that they can end up buying options because what they want to end up doing is they want to take advantage of volatility. And many times that'll end up working. I like actually doing the opposite side. You know, most successful options traders are contrarian by nature. And what ends up happening is that when you take a look at sometimes in a market and an individual company that you like that has really good fundamentals, you end up believing it, you may want to end up even establishing a long-term position in it. A lot of times what happens is a stock comes down, gets down because of something that ends up happening in the market that you think is temporary. It's not going to end up affecting their business, but it's going to end up happening that it has a short-term effect on bringing them down. What ends up happening is as a stock starts to fall, people are willing to pay more and more for insurance. You can probably see this even if you're not an options trader. If you're watching a market when we end up coming down, if you end up watching the VIX, the VIX, which is the volatility index, it basically measures the volatility of the S&P 500. As the market comes down, you'll actually see it go up. For the options traders, a lot of times they watch implied volatility. Think of implied volatility as the price of insurance. So, you know, you take a company that I've traded for a long time that I like a lot, IBM. What ends up happening is that there may end up happening where, you know, there's some bad news or earnings were a little bit less than people ended up expecting, or other things where stock may end up being driven down and the volatility goes up. I love to take advantage of that. I kind of take a look at it where if people want to end up gambling, I want to play the house. I want to be the casino. Okay, because I know that especially when things end up moving in the market quickly, people are going to end up being a little bit irrational. They're going to be willing to end up paying more, you know, just get me out of this position, or I just need to insure it no matter what it costs me. So what I wanted to end up kind of drawing on the board for you in a real quick fashion is that let's use IBM for an example and saying it was trading somewhere around 180. If the stock price is at 180 and we start to end up dropping to 175, what I'll end up doing sometimes is that I'll end up selling a put at 170. And if my graph, if you end up taking a look at along the bottom here, I wrote down price. Okay, we started at 180, we're down to 175, there's fear. I know because of my technical analysis, and I've traded this thing a long time, I'm comfortable at owning this thing at 170. I'll end up selling a 170 put. If I take a look at what my P&L graph might end up looking like, it'll end up looking like, you know, I'll make X number of dollars, and then I'll end up starting to lose money at 170. So my break even might be at say if I got $3 for it. Now my break even's at 167. So I make $3 no matter what happens. If we're at 170 or above, I'm making $3. Now, you have to be a little bit careful for this because, and I never love to jump into this thing big. I like to end up taking it in very, very small pieces because if it keeps going down, I'm going to need to end up managing my risk. So this is a strategy where you're going to have definite edge. I really like it, but you're taking the risk. You're playing the insurance company. And if it's a company that you know, you've traded a long time, you're comfortable with, you know, would I be selling, you know, puts on something like a Netflix? Okay, when they end, no, you want to be very, very careful in this. But in an environment like this, you'll see that as soon as it stops and it bounces up a little bit, you end up collecting money. You're collecting money in two ways. Every single day, that person is paying to rent that put, if you will, you're collecting money. For the options traders amongst you, you probably know that it's called theta, right? It's how much money you collect every single day in the time decay. The other thing that happens is that as soon as it starts to stable, that very, very high implied volatility that was making the prices of the options go up, it'll end up starting to subside also. So you have two things kind of working for you in addition to the price. So that's where your edge is, okay? Watch your trade-off because every trade, okay, especially in options, has a trade-off. Your trade is you have risk if it keeps going down and the fear keeps getting greater. But all in all, you'll have a slight edge doing it. So that's today's lesson on selling puts. Thank you.